Morning. Today is April 3rd, 2025, the day after Liberation Day, as it has been dubbed by President Trump. Today is our inaugural video. We are going to go through a little preview of our March 2025 monthly commentary. We'll hopefully do this every month ahead of the release of the commentary to give you a little bit more meat around our thoughts and share a few charts with you. So, as I said yesterday, was a big day for everybody. I think globally, the U.S. administration has decided to slap very high tariffs on most of its trading partners. With that, the U.S. average tariff rate is going to go much higher. It was around 2% last year. It's probably going to be anywhere between 18 and 25% going forward, assuming that everything that's been announced yesterday goes forward. This is a very high tariff rate. Just for historical perspective, you see in the 1930s, it crested around 20%. And that was the height of the Great Depression, when the Smoot-Hawley Act introduced a lot of tariffs in the U.S. economy. So tariffs are likely to drive a lot of economic pain in the U.S. and around the world. So far, we've seen estimates from the sell side telling us we should expect inflation in the U.S. to be up between 1% and 2% versus the baseline, the base case, and then GDP growth down 1% to 2%. And that doesn't even take into account uncertainty. The effects of uncertainty are important. Economic agents do not like uncertainty. Households tend to defer large purchases and increase savings. Companies tend to defer investment and hiring when uncertainty is high. And as we can see from this chart, trade and fiscal policy and other types of policy uncertainty in the U.S. is off the charts. So taken together, the tariffs and the uncertainty will likely keep driving U.S. growth momentum lower. So Wall Street consensus and the FOMC have been revising their estimates for 2025 growth much lower. We think this has much more room to fall, particularly given the tariff announcements yesterday. So most estimates we've seen peg the U.S. GDP growth, they're preliminary estimates, but probably around 0.5% to negative 1% for 2025. So that's a very big downgrade from where we were just a few months ago, where expectations was for growth to be above 2%. And so with that, a big theme for us over the last 6 months has been this decoupling of growth and of monetary policy between Canada and the U.S. And so we had been positioned for Canada and the Bank of Canada to cut rates more here because of our weaker economy. And that's largely played out. The BOC is cut by a cumulative 2.25%, whereas the U.S. is only cut by about 1%. So we have been transitioning some of our duration exposure across the funds to the U.S. because of this dynamic where we thought rate cuts have mostly played out in Canada. The U.S. This idea of U.S. exceptionalism is becoming increasingly shaky with the trade war and the difference between interest rates, which we show in Figure 4 here. The difference in 5-year government bond yields has gone to such an extreme that we thought better to position for U.S. weakness to be priced in, and that's what we're seeing today. Canadian bond yields are a little bit lower, but not a whole lot, whereas in the U.S. they're much lower because this very large increase in tariffs is being seen as a very large negative growth shock. In terms of risk assets, equities are down materially year to date. Credit spreads are moving wider or higher, and we're starting to see credit decompression, meaning high yield is underperforming its usual beta to IG. Our credit hedges are in high yield because we thought that high yield was the best and cheapest hedge for us, and it's performing well. So we expect that to help with performance over the next few weeks. And then, so in summary, the trade war is now global. U.S. economic policy uncertainty and tariffs is weighing on global growth outlook. For now, we think that the resurgence of goods inflation will handcuff the Fed and the BOC, but over time, as growth deteriorates further, we'll see the market probably force the Fed's hand into cutting rates. We are very defensively positioned in credit, and we have some rate exposure in the U.S. to benefit from this growth outlook that's quickly deteriorating and a continuation of the rate cut cycle. So the monthly commentary should be out next week. I hope you enjoyed this video, and thank you very much for your time. Have a good day.